Hello and welcome back to my channel, Dividends and Investing with Auditor Dan. Hope you all having a nice Friday like I am. Just finished some lawn work, some mulching. I went to the driving range for a bit. So it's been a good Friday off. So like I said in my previous video, I wanted to go over a report that I have from the Hartford Funds. Um, they've done this report before. I think the other one I have is 2019. So they do this on a regular basis. So it's a report that cites research in it. Um, Investing research itself is hard to find because a lot of it's behind paywalls basically, and services that are just difficult for retail to find. So you get summaries of research in these reports, and I've seen Merrill Lynch does these types of things. Charles Schwab does these too. They can do newsletters. These are useful piece of information for retail traders, um, and a lot of the big firms do these reports. Um, so this is talking about dividend investing for long periods of time. We're not just talking about the current period, which a lot of you from YouTube are probably have only invested probably in the last decade. Like the last, I don't know what you call it. I guess the tech boom era, maybe from like the Great Recession to the end of the COVID lockdown last year before everything went 20% down. To me, that's kind of an era of the look at the Nasdaq 100, the tech boom of these big tech firms. So we'll go over this. A lot of the research goes way back further than that here. So this here, so just as a background, so 80 since 1960, 84% of the total return of the S&P can be attributed to reinvested dividends, right? So how do you if you say you just buy the S&P 500, your gains come from reinvested dividends, and it also comes from the appreciation of the assets. So the stock prices go up. So that's how you get your return. So if you can see here, over long periods of time, like quite a significant portion of your return is just by dividends reinvested, not just the appreciation of the stock. As you can see, it's a pretty sizable difference. So dividends are an important part of investing in the stock markets. Even if you're not going to be a dividend investor, if you're an index investor, you still benefit from this. Now here they go over by decade the percentage of your gains in the market from either stock appreciation or dividends. So you can see it does fluctuate over long periods of time. The recency bias, a lot of people will be like, oh, dividend investing is for boomers or it's in the past. I mean, yes, recent history, smaller portion of the returns of the market have been dividends the last like 20 years. I mean, but as you can see, this fluctuates wildly. There's nothing to say that the next 10, 20, 30 years, we couldn't go back to a situation like, I don't know if you all remember, America was in a recession in the 70s, right? There was the oil crisis, there was a lot of problems during that time, and 73% of the market's return were dividends in that decade. Something to think about. If you think America is going to trade sideways for the next 10 years, or I don't know, I guess if you believe the market's going to hell in America, which I'd be like, why are you investing in America's stock market? So we'll leave that aside. So you can make your own judgments here. So over this whole period, there's 40% of the return over this whole period was from dividends. So it's not quite half, but it's a significant portion. So they've played a large role in the return of the market. This just is the historical yield of the market. It makes sense why it's lower because, like we said, what's boomed the last 10, 12 years has been like big tech, Nasdaq 100. So the yield's gone down a little bit. Um, Historically, you can see for long periods of time, the historic return of the markets was higher than recent. So it is kind of an interesting trend. So there were a few parts of this report I thought were very interesting. So they took the let me see if I can read this right. Yeah. So they took dividend paying stocks S&P 500 index and they broke them into quintiles. So the first quintile was the highest 20% of yielders, and then 20%. The next 20% were the second, third, fourth, obviously. So the fifth is the lowest paying dividend stocks. And they went. I mean, this is a huge report or research paper from the 1930s all the way to present. So it's interesting to note that over half of the time the highest, quintile, second, third, all outperform the market in general. So the highest yielding stocks over long periods of time are performing better than the index itself. Um, you could think first quintile, you're probably thinking Altria. Okay. Second quintile, maybe you're thinking Verizon. Third quintile, let's say something like Coca Cola, maybe. So I'm trying to think of yields. Fifth quintile, you're talking like something paying like probably 0.4% or something. They're just paying this little pitiful dividend. So over long periods of time, dividend high yielding stocks do perform well. So put that aside. That's a piece of information for you. And then this part just shows it breaks it into actual the yields of the quintiles by the market. So you can see like the tech boom era. I mean, it is interesting. So this is the height, 2010 to 2019. The market return an average 14, almost 14%. So the highest yielding dividend stocks almost performed just as well. Um, and then some of them actually did outperform the market in general. So this was an interesting study. There's a lot of pieces to this study. I'll try and be brief. I don't want to spend too much time. So they went from 1973. They broke all the companies in this report. So we're still talking S&P 500. They broke the companies into dividend grower initiators, companies that are growing dividends or initiating, dividend payers where there was no substantial change to their dividend policy. You can look here, and then no change, non-payers. So you can get this and read this for yourself. And then they would make adjustments every 12 months to what category they would place them in this study. So they're breaking companies into now this is the more interesting part as far as my concern. So now we're looking at not just comparing the market to dividends in general. I don't know how much you can gather from that. So now we're saying, okay, let's take dividend stocks and then put them into categories themselves. Dividend growing, and so companies initiate and grow. They put them in the same category. Companies that just pay a dividend, and then companies that don't pay a dividend, right, compared to the market. So here you can see over long periods of time, the performance difference has been it's quite a stunning difference actually in return. Um, and they even know here corporations that consistently grow their dividends have historically exhibited strong fundamentals, solid business plans, and a deep commitment to their shareholders. Um, I'll get into that more in the future, but I mean that in essence is what I believe. The focus should be on the dividend growth companies. I think that the characteristics of a dividend growth company are more beneficial to you as an investor over long periods of time. You're more likely to have a company that's making decisions for the investors and not just for their own benefit as a business. And there is a difference. I will tell you, there are companies that make decisions just for themselves and not for the benefit of investors. Um, and I'll have examples later on to go over that. So you can see like when you actually start to separate dividend stocks into different categories, you can see the dividend growers are substantially outperforming the ones that have no substantial change to their dividend policy. I mean, obviously, I think everyone here would understand why dividend cutters and eliminators perform terribly. Um, and that's something I'll get into later on about like maybe the philosophy of how I look at stocks. What do you do? I mean, they grow and grow until someday they're not going to grow. And then what do you do if when they start cutting their dividend or they don't grow it as fast as you want? So these are more minute, specific details. Uh, this goes into payout ratio information. Those were the two biggest parts to this. So I find this report interesting. It's not hard to find. If you want to go get this, I'll leave it here. You can Google this. You can get this yourself. Read it and start to understand. So the fundamentals of why you would be a dividend investor, but more specifically, why would you look at companies that have growing dividends? What characteristics do those exhibit that would be beneficial to hold over long periods of time? And then I'll do another video after this. I'll post it soon. Um, but why worry about long time frames? Why is the focus investing in things over long periods of time? So why don't you just time the market and just buy and sell and swap stocks all the time? There's reasons why you shouldn't do that. So there's that point. And then this is I got this from I think it's a financial advisory. It talks about that second report. The chart's a little easier to understand. It's the same research from Ned Davis. So it breaks the chart. You can see the growing dividend stocks in this study outperform the ones that were simply paying, and then both of those did outperform the broad S&P 500 market in general. Okay, non-payers and then cutters. I mean, if you want to only go by certain, if you want to have recency biased, I guess you could. I mean, I'm looking at this stuff from a 20-year time frame, and I probably got 20 more years to go. So the last thing I'll share in this video, I can link this if you want. It's the same information from the Hartford, but you can understand the different growth rates. It's not huge differences. Like we're not talking about 10xing return differences. These are slight variances that over long periods of time will benefit you. So the last thing I want to share, well, I'd like to get into more of the philosophy of investing in general, not just dividend, but because I know a lot of people online, I see it. I saw it last year when you guys hit the first time that markets went red. And then I see the panic and I see people selling stuff when it goes red. And it's just like, why are you investing? I feel like they missed the point. Are you investing to try and make $1 million and just 1,000 extra money and do options? Or are you trying to build something? To me, I'm trying to build a dividend compounding machine that'll benefit me and allow me to retire when I want to retire. I want to retire at 55. That's been my goal. I want to go live on the beach, and I'm going to get there. I'll have I'll have to do another video where I'll show my plan, because dividend investing's part. I have other investments and assets so it's like a triangle of things I have to prepare for retirement. But there is no passive investing, is what I would like to say last on this video. You got to understand, like, oh, I'll just buy like SPY. I don't even need to worry about any of this shit. I'll just passively invest. You're dividend investing stupid. If you want to be an index investor, I'm all for that. As long as you do it properly, which retail screws up even, let's be real. You guys screw up index investing. All right. So this is a frontline report or news story, and it's two people that talked about their experience during '08. And I just understand, like, you guys have only invested, a lot of you, in the good times. Like, you need to set yourself into an investing process that you can do when things go terribly wrong in your personal life and your financial life. Because the worst thing you can do is sell, or put yourself in a situation where you have to sell everything to support yourself. And you won't be that, won't be you. I mean, but I'd like to play this. These people probably didn't think they would ever have problems. They thought everything was going great in life. So this is the Great Recession time period, okay?
I have no job. I have a house payment. What do I do? And I was scared, really scared. I didn't have much of a retirement left. I couldn't even borrow against it. And it was just something that I never foresaw, ever. Losing my job, ever. Never.
The worst was yet to come.
Concerns about shaky home mortgages are triggering fears of a financial meltdown.
Talk about the speed with which we are watching.
8 years later, savers were hit again.
Well, and the mortgage market is far from over.
This is volatility we haven't seen, of course, since way before you and I were
more trouble ahead for the nation.
When the housing bubble turned into the crash of 2008, it put retirement even further out of reach.
Economic turmoil of recent years is putting a comfortable retirement at risk for many Americans.
It's like, holy smokes, how do you stop the bleeding?
The reality of what you've lost is huge. I mean, not only have you now lost half of your 401k, but your house is not worth anything anymore either. So anything that you thought you were going to have there is gone, and now half of your 401k is gone.
You know, if it took 13 years to accumulate $80,000 and 1 year to lose half of that, and then try to get that back in another 13 years and only be at the $80,000 that you were 13 years ago, the math doesn't work.
So just imagine like half of their 401k disappeared. Now, what if can you imagine, like, maybe you don't know anything about investing. So you're a passive investor. You think, I'm just going to dump it into the markets. I don't care. Don't worry. What happens if half of it just disappears? Like you can't, I don't see how you can just be a passive investor. You need to have some understanding of how the markets work. Can you imagine if they sold? Go look at the markets. If they sold at the bottom of the Great Recession, think of the devastating loss in their assets that they sold at the worst time possible. Like, you will never recover from that. So in the end, I don't care if you want to be a dividend growth investor or an index investor, which are the only two processes that I've seen that will, over long periods of time, make sense. I'll be honest with you. I would ask you, if you even ask me, well, what should I buy, this or that? It doesn't matter. What can I get you to buy? And how do you set your finances up so when this happens again, it's going to happen again. Your index funds or whatever, everything gets cut in half. Like, are you in a bad situation? Are you going to sell? Did you put your emergency fund away? Are you paying your credit cards down? Do you have at least a basic understanding of the markets? How can you set yourself up so you won't sell at that worst time of your life? Your house is underwater. Your 401k has lost half its value. What are you going to do? So in the end, I've set myself up in a system where I feel confident I can invest, and I will keep investing my dividends into dividend growth investments, even if things go bad. I didn't bat an eye last year, 20% drop. My wife's 401k started the year and ended the year at the same amount. All the contributions she made for nothing. But it doesn't matter. That's how you invest. You're not timing the market. And if you were thinking, oh, I should have put my money in a money market account at the beginning of the year, and then I wouldn't have lost all my 401k, I'd be like, you're doing this wrong. But you need to have an understanding. So if I can help, or maybe I can point you in a different direction. But like, the goal is, like, how do you set yourself up so, like, when this happens, I mean, another reset, it's going to happen at some point. You're going to lose your job. And maybe, if your company's laying off people, maybe the whole country's going to hell. Those things tend to happen at the same time. So now your 401k is crashing, you've lost your job. It all just happens at the exact same time. And you should think about that, and like how you're going to prepare yourself when you do your investing. So I don't care if we want to debate, like, oh, this ETF is 0.08 fund or expense ratio, and this one's 0.09. So obviously less expensive. It's like, okay, whatever. Again, the goal is, are you prepared for when the worst of the worst happens? And are you not going to sell? Because that's the most important thing, that you don't sell, and you're in a long-term investing strategy that you can stick to in the markets. But you have to take ownership of that. You can't just trust somebody that's on YouTube. So I guess this went a little beyond the dividend report. So be it. I'm going to cover another report, so I'll release these two back to back, and then we'll go into it at that point. So, all right, I will be seeing you soon. Have a good day.